Let's talk about the VIX. The VIX is known as the fear index. So the VIX equals fear index. Now I've seen it written out this way. I've also seen it with a dollar sign in front of it, and this is just going to depend on your trading platform, so how they use it, because it's not really technically a stock, so sometimes they'll put a dollar sign in front of it. Sometimes it'll be a little bit different, so just watch out and see how your trading broker is doing it. In either case, the VIX, it's known as the fear index because it's based on the amount of puts that are purchased, stock option puts. So the more that the stock option puts are purchased on the VIX or the S&P 500, that means the higher the VIX. Okay, and that's why it's known as the fear index. When puts are high, that means people are buying protection. Typically, people buy puts in order to protect themselves, or they think that the market is going down because they're able to put that stock to somebody. If the stock tanks from 100 to 50 and you have a put, you're able to put that stock to someone. Now, the more puts that are purchased on the S&P 500, the higher the VIX. And the high VIX versus low VIX is all relative. So you could have a high VIX of, let's say, 30, or you could have a high VIX of 15. It's going to depend on whether you're looking at historical or implied volatility of the VIX. For example, if things have been going pretty good and the VIX has been low, which let's say is 15, and the VIX is kind of going like this, then a high VIX might be only a 20. On other instances, if the market's really rocky and shaky and a lot of volatility, and it's bouncing here from 15 to 25, a high VIX might be in the 35 region. So that's what really is important to understand. It's not that it's high on numeral value, but high based on what you're looking at on the historical level, on the historical VIX. If you're looking at the implied VIX, that is the current state that you're basically in. And that's one of the things that you're looking at, but it's important to understand that a high VIX does not mean a number value. It is basically based on the historical volatility. So what's important to understand about the VIX when you're trading stocks? Well, there's a little rhyme that goes with it. When the VIX is high, it's time to buy. When the VIX is low, look out below. Because the VIX works opposite of the market, and it's not always one-to-one, meaning it's not exactly the same. So when the VIX is up, the stock is down, or when the VIX is down, the stocks are up. It actually kind of lags behind it or goes in front of it. It just really depends because it's based on those put buys. So the more puts that are purchased, that's how the VIX operates. Now, because it lags or goes forward with the market, you don't really know. It's something to watch out for. So that's why this rhyme was created. When the VIX is high, it's time to buy. So when the VIX is high and it's moving up and you know that it's over in this region, what happens to stock prices is they start heading down, okay? Because the VIX is going up, stock prices go down because there's more fear. Fear impacts selling to the negative side. So stock prices are low. So in theory, they should start to head back up soon. So as the VIX is high, stock prices are low. That's why it's time to buy. Now, on the other hand, the opposite of that is when the VIX is low, look out below. As the VIX is heading lower and it hits a lower point here, look out below. What happens here is stock prices, they start heading up because there's less fear. There's less fear in the market. So when the VIX is low, stock prices are high. So look out below. So stocks eventually will tumble because it's all a calibration act. Everything has to kind of calibrate to create a balance. And that's what happens with the VIX. And it's a little thing to remember when trading your stocks is watch that VIX. It's important to understand if people all of a sudden get into that panic mode, the VIX will be coming, or the stocks will be coming down, or eventually they will be coming down. This could actually predict the future of the stock prices if you watch it carefully, but it doesn't always go 1-in-1, so it's something to watch for. It's just basically showing you how much protection people are buying with the puts, because then they're able to put a certain stock to you if it dropped below a certain point. And also they're betting on it that it's going to head lower. So that's what's important to understand when understanding the VIX.